All right, let's dive right into this Q2 2026 earnings release from Popular Inc. We're going to break down this highly quantitative report into a clear, structured explainer. Now, we're looking at a quarter that isn't just about some seriously impressive numbers, but it's also about a massive changing of the guard at one of the top 50 bank holding companies in the US. To help us digest this dense 15-page financial report, here's our roadmap for today's explainer. We'll start with Q2 earnings and leadership, then look at revenue drivers and income, dig into the balance sheet and deposits, break down the credit quality, and finally finish up with their outlook and capital returns. Okay, let's kick things off with Section 1, Q2 earnings and leadership. We're going to start right at the top with a massive hook that pairs a highly profitable quarter with a major structural shift. Popular Inc. reported a staggering $278 million in net income for the second quarter of 2026. This absolutely proves their solid quarter claim right out of the gate. You know, when management says they had a good quarter, this right here is the hard proof they point to. It's a massive number, and it really sets the tone for this entire financial release. And looking at the growth trajectory, you can see it clearly. We're talking about a 13% jump just from Q1 of this year, and a striking 32% increase compared to this exact same quarter last year. When you see a bank growing its bottom line by nearly a third year over year, that tells you their core strategy isn't just working, it's literally accelerating. Now, what's really interesting here is how the current CEO, Javier D. Ferrer, is injecting a very human element into these robust financials. He's looking at a highly profitable bank, a united front, and deciding, you know what, this is the exact right moment to step away on a high note and hand over the reins. And this transition is incredibly carefully structured. Current CFO Jorge J. Garcia will step smoothly into the president and CEO role by September 2026, which ensures total strategic continuity. It's honestly a textbook succession plan. They aren't bringing in an outsider to shake things up. Instead, they're promoting the chief architect of the very financials we're looking at today. Let's move on to Section 2, Revenue Drivers and Income. We're going to look under the hood to see exactly why the bank made so much money this quarter. We know the destination was $278 million, but how exactly did they get there? Grounding our analysis right in the source document, you can see these raw financial highlights confirm that $278 million net income, along with a tangible book value of $87.94 per share. This basically shows a strength across virtually every single key metric. So think of net interest income, or NII, as the core flywheel of the bank. This quarter, it rose to $693 million, which is up $23 million from Q1. This is fundamentally how a bank breeds, right? They take in deposits, pay a certain interest rate on them, and then lend that money out or invest it at a higher rate. The difference is the NII, and man, Popular's breathing is incredibly strong right now. The crucial point to take away here is that this core engine is just humming efficiently. Loan and investment yields are actually outpacing a very slight bump in deposit costs. While a lot of other banks right now are really struggling with exploding deposit costs because customers are demanding higher rates, Popular only saw their deposit costs tick up a single basis point to 1.57%. Meanwhile, they drove higher income from U.S. Treasuries and commercial loan growth, which kept their net interest margin perfectly stable. Moving right along to Section 3, Balance Sheet and Deposits. Now we'll see where the raw fuel for that revenue engine is actually coming from. Total assets expanded by $2.8 billion from Q1, primarily fueled by heavy strategic investments in securities. That brings their total footprint to nearly $79 billion. But as we know, assets don't just appear out of thin air, right? They have to be funded by something. And what stands out immediately on this $70.2 billion pie is the massive 32% slice representing Puerto Rico public deposits. These grew by $3 billion this quarter alone. The bank now holds $22.7 billion in these public deposits. This is an absolutely crucial strategic advantage and the main driver of their liquidity right now. This influx of public funds is the exact fuel that allowed Popular to increase their average earning assets by $1.8 billion, specifically by purchasing U.S. Treasury securities. Basically, they took that $3 billion public deposit surge and immediately put it to work in safe, higher-yielding government bonds, and that directly drove the net interest income growth we were just talking about. Okay, let's dive into Section 4, Credit Quality Breakdown. Here we need to impartially look at how they're navigating some speed bumps because, well, it wasn't all just smooth sailing. To cut through some of the dense financial jargon for a second, here is the exact sequence of how management resolved a major $155 million commercial loan relationship. They made a strategic decision to just rip the Band-Aid off. They took a painful $71 million hit right up front so they could move the remaining $84 million off their books and sell it by early July. This actually presents a fascinating strategic contrast in their portfolio. While they took a hit on that specific commercial resolution, the consumer side of the book actually grew healthier. Management noted that the commercial issues were strictly borrower-specific, definitely not a sign of a broader economic crash. In fact, everyday consumers paying off their car loans and credit cards actually drove a $10 million improvement on the retail side. Now, while the official net charge-off ratio spiked to 1.05%, the crucial takeaway is that if you remove that isolated $71 million commercial hit, the core ratio was an incredibly low 0.33%. This is exactly why you always have to look past the headline numbers. A 1.05% loss ratio might cause a little panic, but stripping out that one strategic move reveals a loan portfolio that is actually performing exceptionally well. Finally, let's move to our last section, Outlook and Capital Returns, to see how the bank is translating this successful quarter into forward-looking shareholder value. Because of that huge surge in Puerto Rico deposits, management is actually raising their full-year revenue guidance to an 8% to 9% increase, and that's even while adjusting charge-off expectations slightly higher. This is a very confident signal to the market. Basically, they're absorbing that commercial loan loss we just discussed, but their core revenue engine is running so hot that they still expect to make significantly more money this year than they originally thought. So they are aggressively rewarding investors. They're hiking the dividend by 20%. And the board just authorized a bold, massive new $1 billion buyback program after exhausting their previous funds. Think about that. When a bank authorizes $1 billion to buy its own stock, it's the ultimate vote of confidence. They are effectively saying, we have so much excess capital and we believe our stock is such a great value that we're going to be our own biggest buyer. Which leaves us with this final pivotal question. As leadership transitions this fall, how exactly will the incoming CEO, Jorge J. Garcia, utilize this new $1 billion share repurchase authorization to guide Popular's next chapter? He is inheriting a rock-solid balance sheet, an expanded revenue engine, and a massive war chest. It's a phenomenal starting point, and for sure, what he does next will be fascinating to watch.